Here's what they don't tell you about student loans, and it could end up costing you tens of thousands of dollars. Most people treat student loans like free money while they're in school. You sign the paperwork, you get the funds, and you don't really think about it again until you graduate. And that's exactly the mistake, because the clock starts ticking the moment you borrow. And by the time you throw that graduation cap in the air, you may already owe more than you originally borrowed. Welcome back to Financial Fundamentals, where we break down money concepts so they actually make sense. Today we're talking about student loans, what they actually are, how repayment works, and the things nobody bothers to explain until it's too late. By the end of this video, you're going to understand how a student loan works from start to finish, what your repayment options look like, and what the real risks are, so you can make a smart decision before you sign anything. Let's start with why this matters so much. In 2018, about 70% of higher education graduates in the US used loans to help pay for school. Right now, student debt is the largest non-mortgage debt category for US households. We're talking $1.73 trillion. That's not a typo. Trillion. With a T, this is one of the biggest financial decisions you will ever make. Bigger than a car. Second only to a house for most people. And unlike a lot of financial decisions, you're usually being asked to make it when you're 17 or 18 years old. So the fact that you're here, taking the time to actually understand this before you sign, you're already ahead of most people. Okay, let's build this from the ground up. A student loan is borrowed money. That's it. Someone, either the government or a private lender like a bank, gives you money to pay for school. And you agree to pay it all back, plus extra. That extra is called interest. Interest, let's stop on that word for a second. Interest is basically the cost of borrowing. Think of it like a rental fee for money. If your friend lets you borrow $20 and says, "Pay me back $22 next week," that $2 is the interest. Lenders do the same thing, just at a bigger scale and over a longer time. Now, there are two main categories of student loans, and this distinction is really important. The first is federal student loans. These come from the US government. Federal loans usually have fixed interest rates, meaning the rate is locked in and doesn't change. They also come with a lot of built-in protections that we'll talk about in a minute. You apply for these through a form called the FOFSA. The second category is private student loans. These come from banks, credit unions, or other private lenders. They tend to have stricter terms, fewer protections, and can have variable interest rates, meaning your rate could go up over time. Think of it like the difference between borrowing money from a family member who cares about you versus borrowing from a stranger who just wants their money back with interest. Federal loans are almost always the better starting point. Always exhaust your federal options before you even look at private loans. And because interest rates and rules change every single year, always check the current numbers at studentaid.gov. That's the official government source. Now here's something a lot of people don't realize. There are actually two types of federal loans, subsidized and unsubsidized. Here's the difference. With a subsidized loan, the government covers your interest while you're in school. You're not being charged anything while you study. Think of it like someone putting your bill on hold. With an unsubsidized loan, interest starts building from day one, even while you're sitting in class sophomore year, even while you're home for winter break, even the moment you sign the paperwork. So by graduation day, you already owe more than you originally borrowed. That's the part nobody explains at orientation. That's why understanding this before you sign matters so much. Okay, let's pause here for a second. So far, we've covered what a student loan is, what interest means, and the difference between federal and private loans. We've also talked about subsidized versus unsubsidized. That's a solid foundation. Let's keep going. Now let's talk about repayment, because this is where a lot of people get surprised. Most federal student loans come with a grace period after you graduate or drop below half-time enrollment, usually 6 months. That's your runway before your first payment is due. Use that time to figure out your plan. Don't just wait for a bill to show up. Once repayment starts, you have options. The standard repayment plan spreads your payments out over 10 years. That's the default. But there are also income-driven repayment plans, and this is worth understanding. Income-driven repayment, let's unpack that. These plans tie your monthly payment to how much money you're actually earning. If you're making a modest salary right out of school, your payment goes down to reflect that. Think of it like a sliding scale. You pay less when you earn less. Sounds great, right? Here's the trade-off. Income-driven plans usually stretch your repayment out to 20 or 25 years instead of 10, and the longer you're repaying, the more interest piles up. So you might pay less each month, but you could end up paying more overall. There's no automatically right answer here. It depends on your income, your goals, and your situation. The point is knowing the options exist so you can make a real choice. Let me walk you through a concrete example. This is illustrative. These are round numbers to show you how the math works, not a prediction of what your loans will look like. Meet Jordan. Jordan just graduated with about $30,000 in federal student loans, which is actually the average for bachelor's degree borrowers in 2019. Jordan chooses the standard 10-year repayment plan at a hypothetical 6% fixed interest rate. At 6% over 10 years, Jordan's monthly payment comes out to roughly $333 a month. That's manageable if you land a decent job right away. But here's the part that sneaks up on you. By the time Jordan makes that last payment after 10 years, they've paid back the original $30,000 plus about $10,000 in interest on top. The total cost of that education was $40,000, not $30,000. Now let's say Jordan's starting salary is really modest. Jordan could switch to an income-driven plan. Monthly payment drops, maybe to $150 a month. That's real breathing room. But now the repayment stretches to 25 years. And over 25 years at 6%, the total interest paid climbs significantly higher than $10,000. Jordan pays less each month, but more in total. Now compare Jordan to a classmate who borrowed $60,000 in private loans to attend a for-profit school and didn't finish the degree. That person has a much larger balance, fewer repayment options, and statistically a much higher chance of ending up in default. Let's talk about that word. Default. Default means you've stopped making payments and your loan has gone into a kind of financial red zone. This is serious. For federal loans, default can lead to wage garnishment. That means money gets taken directly out of your paycheck before you even see it. Your tax refund can get seized. Your credit score takes a major hit. And remember, student loans are incredibly hard to wipe out in bankruptcy. This isn't like a credit card balance. It follows you. Here's something that surprised me when I first learned it. Borrowers who don't finish their degree default at roughly 3 times the rate of borrowers who do. You took on the debt, but you didn't get the credential that usually helps you earn enough to pay it back. That's a really painful situation to be in. And the schools where students carry the highest debt loads are disproportionately for-profit colleges. The 12-year default rate at for-profit colleges was reported at 52% as of 2018. Half. That number should make you stop and think very carefully before enrolling at any for-profit institution. All right, before we wrap up, what's the one thing from today that surprised you most? Think about that for a second. Maybe it was the fact that interest builds while you're still in school. Maybe it was the difference between 10 years and 25 years of payments. Maybe it was that default rate. Whatever it was, hold on to it. Because that's the thing you're going to remember when someone hands you paperwork and says, just sign here. Let me also bust a couple of misconceptions before we close. Misconception 1. Student loans just go away if you don't deal with them. They don't. They are one of the hardest debts to escape. Federal loans can lead to wage garnishment, seized tax refunds, and lasting credit damage. Misconception 2. Interest only happens after graduation. Not true. On unsubsidized and private loans, interest starts building from day one. The balance you owe at graduation is often larger than what you originally borrowed. Misconception 3. All student loans are basically the same. They're not. Federal loans come with income-driven repayment, deferment options, and forgiveness programs in some cases. Most private loans offer none of that. Let's bring it all home. A student loan is borrowed money for education that you must pay back with interest. Federal loans are generally safer and more flexible than private loans. Interest can start building before you even leave school. Repayment usually begins 6 months after graduation. You have choices, a standard 10-year plan or income-driven plans that adjust to your income, and each has real trade-offs. Not finishing your degree is one of the biggest repayment risks. And for-profit institutions deserve extra scrutiny before you commit. The students who struggle most with loan debt aren't the ones who borrowed the most. They're the ones who borrowed without understanding what they were agreeing to. You just spent the last few minutes changing that for yourself. That matters. If this video helped you understand something that felt confusing before, hit the like button. It genuinely helps more people find this content. And if you've got a friend or a younger sibling who's about to sign their first loan papers, share this with them. This is exactly the kind of thing that should be common knowledge, and it just isn't. Drop a question or a topic in the comments. If there's a money concept that's been rattling around in your head and you can never quite get a straight answer on it, tell us. We go through every comment, and we might make that the next financial fundamentals video. This video is for educational purposes only and is not financial advice. Markets and investments carry risk, including the possible loss of principal. Always do your own research and consult a licensed financial professional before making investment, tax, or money decisions.